Welcome everyone to this is the second class of the Money IQ training. For those that were in my training, like in the past, it used to be like 10 weeks long, if you remember, maybe even a little bit longer, but I've condensed and kind of refocused it around key things that everybody needs to know. I took out a number of things around, um, you know, um, if you look at how to do a stock evaluation, a direct stock chart type evaluation, really not everybody needs that. That's needed by some people, not needed by some others. So I don't think that is called when it comes to understanding finance. So I took a number of things out. That's why I've limited it to 3 classes. And hopefully, everyone is able to get the key or the core things that they need to know. I won't teach things that has to do with stock charts analysis as I taught in the past. There's really no need for that, honestly speaking. If you understand the number of what I've been sharing, you will get as good a result, if not better, actually, if you apply it properly. All right, so today we have a second session of 3, and then in November we'll have the third, which essentially will round up the 3 core content. Now, as people need to, and they come to me directly, I can share some other things, but these are the core. So today we'll be looking at financial planning process, steps 3 and 4. I went through step 1 and 2, and we had some assignments in the first class. Today we'll also look at budgeting. As I've had the privilege of being in the marriage ministry for a while, I've seen that one of the core challenges that people have in their homes, in their finances, really revolves around money. And to a large extent, it's really because they do not plan. They do not have a good understanding of why budgeting. When you use the word budgeting, it seems like it's a very difficult financial term, but I want to try and demystify it, make it as simple as possible. It's really just thinking about what you want, what is coming, and what is going out. It's pretty simple. And then, the other side of that is reconciliation. Again, another high-sounding financial term. But really, all it means is that, look, if you know what you plan, going back and doing what you said you will do, that is what reconciliation is about. And then tonight, actually, a big portion of the class I want to spend on investment vehicles. Like I said, I've really refocused the course content around core items. And this third bullet is so critical. Now, if you don't plan, there's going to be no need for you really to even understand investment vehicles, because you will not be able to have enough set aside to invest. So it's important that we all understand and plan, and we're able to set some things aside so that we can invest. All right, so let's kind of go through it. I won't go through this. I hope you all did the assignments. I honestly feel the way to get the most out of these sessions is to spend some time with those assignments by yourself, so that if you have questions, you can bring it back to the class or ask me offline as needed. But it is in the best interest of everyone to really take time to do those assignments. If not, you put yourself at a disadvantage. So I hope you've done this first assignment, which really revolves around understanding where you stand financially speaking. There are 3 elements of that, as I've explained in the past, but I won't reteach it. For those that missed the first class, I would recommend that you go through the video that I sent out. Is the class teaching from the last session. Your net worth, which I explained, is the difference between your total assets, the things that you own, and the things that you hold. The difference between the two is, in financial terms, from personal finance point of view, is called your net worth. So I hope you all know where you start right now from a net worth point of view. I explained the burn rate, which is what you spend, what goes out from you in terms of expenses on a monthly basis. And then I asked you to calculate also the run rate, which is, if you really look at what you have in terms of financial liquid financial assets, which is what they call current assets. Things that is either you have it in cash or it can be converted to cash in a very short time. Usually in financial terms or in accounting terms, current assets refers to anything that can be turned to cash either immediately or within a period of less than 12 months. They are thought of and referred to as current assets. So Whatever your current asset is, divided by your burn rate, which is the amount that goes out of your, out of you from a financial point of view on a monthly basis, is simply your how many months you have before. If you don't have any more income coming in, you will be in trouble financially speaking. Okay, so that was the first assignment, and I'm really hoping everybody has done it. Nobody came back to ask a question. So my hope is that we've all done that. And I explained in that class that you should also kind of do your long-term plan. This is kind of where we will start, kind of understand where you want to be, your goal. And I spent some time going through this worksheet the last time, which is going to be what you will use. I explained how to use it. I hope you've done this. Every class will build on the last. Like I said, it's 3 sessions and that's it. So if you've not done the last one, you will miss out quite a bit on this. So I recommend you watch that video I sent. All right. Okay, so let's move on to today's session. So last time I actually taught us about the first 2 steps, which is determining your current financial status, which I just went through again briefly. And then I also talked about the next step. This is a financial planning framework that is used for personal finance by CFPs and other financial professionals, right? So it's not, I'm not inventing this. This is things that is used by professionals. Number 1 is understand where you are at. Number 2 then is to define where you want to get to, which is what those 2 assignments cover. So today we will not go back to talk about that. We'll focus now on number 3, number 4, and then, like I said, the goal for today, really to a large extent, is to talk about the various investment vehicles. What are the things that can help you to achieve your goal? So once you've done those assignments, you've been in the first class, you understand and you will appreciate the question or the needs around, having a goal in mind. Once you have a goal, the question then is, what are the steps you need to take to get to your goal? I always ask people to break. Let's say you say, I use the example of someone that just graduated college. Let's say you're age 25, and then you're thinking, by the time I'm 50, which is 25 years from that point in time, I want to have a net worth of 1 million, of 2 million, whatever your goal is. And then I also explained that you need to have a good understanding of why that's important, right? Because that is what keeps you going and helps you to push through the challenges that will surely come on the way. So once you have a clear understanding of the goal, the next question is, how much do I need to then set apart? How much do I need to invest to achieve that goal? Again, that worksheet is what will help you, which is your second assignment from the last class. Keep that in mind. So the third point when it comes to financial planning, step number 3, is what is your course of action to accomplish your financial goal? Once I know where I want to get to, and I know where I'm at right now, what do I need to do to get from point A to point B? That is the third step in the 6-step financial planning process. And that's what we will do. I will walk you through the examples again on that a little bit today. Then the 4th step we'll look at today. 5 and 6 we'll look at next session. But the next step, which is step 4, is evaluate your alternatives. What are the alternatives to accomplish that goal? If I understand that these are the steps that I need to take, what other alternative might be there for me to go in that direction? What steps can I take that if I don't go in this direction, I could actually achieve the same goal by going about it this other manner? For example, I want to, be able to invest $1,000 a month. I'm just taking that number out of the blue. But how can I get $1,000? That becomes the question that you need to ask yourself. Is it because you have an income, because you hire an employee, and you want to limit your expenses to so much so that you can have that 1,000 left over? That's why I want to go over the issue of budgeting in a minute. This is such a basic requirement. How much do I need to set aside in terms of a saving so that I can invest, towards my goal? That is such a basic element of investment that most people really don't appreciate how critical it is. You know, those that are successful, in one of the books I've read in the past, or maybe a video that I watched about this man who was the first billionaire, John D. Rockefeller. They said, if you can't save at least 10% of whatever you are earning, and it doesn't matter whether you're earning $500 a month or $10,000 a month. He said, if you can't save at least 10% of your monthly income, that the seed of financial independence is not in you, that you will never be financially independent, essentially is what he was saying. They said this man, as successful as he was, if he sees a penny on the road, he picks it. And he will say, like, whoever, misplaced this does not appreciate the value of a penny. And that's the truth. I remember one of the video that we showed the last time from Pastor Adejumo that he has shared with us. I sent that to the group, showed, the power of compounding daily, starting with a very small amount. So maybe your point in terms of how I will accomplish my goal is I will save X and from my income, and I will invest it on an annual basis. Now you've seen what that annual investment can do using the power of compounding that I shared in the last sheet. Or maybe you want to say, for me, I may not be able to save enough to accomplish this goal. Let's say my income is $5,000. My goal is $1,000 a month that I want to save and invest. But after I took out all my expenses, what is left is $200. There's no way I will achieve my goal. So you might start thinking, okay, what else can I do? Do I want to start a part-time business so that it produces an additional income? If you are someone that knows how to write, do I want to write part-time for people, for freelance, whatever it is that can help me to close that gap of 800 towards my 1,000? Do I want to own my own business and stop, work? Will that take me there? Or is it real estate investment? Whatever it is, you need to think through what your alternatives are, identify what makes the most sense, and take steps in that direction. So those are steps 3 and 4 on the financial planning process. Number 1, as we said, is really understanding where you are. Number 2 is developing your goal, which we had assignments that helps to solidify that. Number 3 is, now that I have my goal, what is my course of action? What do I need to save? What do I need to invest? Now, if I know what I need to invest to accomplish that goal, do I have the capability to do so? Or are there options that, even if I don't have the direct capability, based on what my status is right now, are there other options that can get me there? Those are really the steps 1 to 4 of personal financial planning now. All right, and this is not too far from even what businesses do, but again, this is focused on personal financial planning. Now, to be able to do that process very, very well, I want to take us through a simple budgeting sheet. Like I said, but the privilege I've had to be involved in the family or marriage ministry, one of the key problems in many homes, in fact, it always ranks among the top 3 to 5 causes of problems in homes, is money. It's always finances, and I always see that it's linked to the fact that people do not plan, they do not budget. If you're going to plan, the number 1 underlying element of planning is budgeting. Budgeting. What's my income? What's my expenses? What's our income as a family? What are our expenses? How much do we need to save to be able to achieve our goal? And doing that as a couple, it not only unites your mind, it not only brings you together as a couple, but it also helps you to work together towards a common goal. All right, so what I'm going to do now is I'm going to kind of show us an example of a family budget sheet that I've pulled together. And this kind of started from me also trying to pull together something that will be useful for my own family. Now, you can take it. I've had people that I taught this and they have something else that they do. You don't have to use what I'm using, but you have to plan, you have to budget. You need to set a goal, you need to work towards your goal. And one of the key elements of achieving that purpose is the process of budgeting. I can't say this enough. If you can't save, you can't invest. You can't borrow to invest. You save. It's what you have that doesn't have anything encumbering it, that you can truly invest. So the key around budgeting is this. What do you want to know what are all your incomes from every form of source that you can make income from? What are your monthly expenses? What are the, what will be left over if you take your expenses out of your income so that you can invest? Or what do you want to save for short-term expenses? You want to plan for owning a house, buying your car? What are those? What's that amount? You want to have a very good idea of all of those kind of things. So what I'll do right now is I will open that spreadsheet and I will walk us through an example. So this is this spreadsheet. After the class, I will share it on the Excel. Please feel free to take it and use it. It's pretty straightforward. You can add rows to it. I will explain it to you. Or you can develop your own. It doesn't matter to me. It just is important that you do this process. If you're a couple, that you work together through this kind of a process. All right. So like I said in that last slide, the first thing you want to do is to understand what is your income. And I always tell people, don't budget on a monthly basis. On a monthly basis, things change up and down. So your budget should be an annual budget. Even if you start building it from a monthly basis, you need to convert it to an annual budget by multiplying it by 12. It's the best way to budget. You reconcile on a monthly basis, and then you sum it all up at the end of the year. But when you're planning, this is actually a good time that this class is coming on. We're almost at the end of October. November is coming in the next week, at the end of next week, I believe it is. This is a time I would, if I'm you, I will spend time to think through how do I use this kind of a sheet to plan for 2026. Whether you are a young person in our midst, or you are one of those that are, maybe married and you need to do this together as a couple, it will work, in either case. All right. So what do you do with this and how do you use it? Really, it's pretty straightforward. As a couple, this was set up for a couple, right? Let's say basic salary for the man, basic salary for the woman. In this case, I wrote, okay, the monthly income, and then I multiplied it by 12 in column E to obtain the annual value. That's essentially what I did with this sheet. And if you want to start from the other hand, because you still need to know the monthly values, because you reconcile on a monthly basis, right? But the annual one is the goal. That's what you're working towards. So in this example, I'm not sure what is happening to the mouse here right now, but in this example, this individual, let's say the man makes $6,000, the wife makes $4,000 a month, and between them, that multiplied by 12 is 72 and 48,000. And then they have some side business. I explained earlier on, you need to think through your alternatives. So in this case, in this example, these individuals have a side hustle that gives them an extra $1,250 a month, something 15,000 a year. They make a bonus of 6,000 a year, and then they have some other income from other things, consulting. Maybe they hand some dividend somewhere, whatever it might be. That sums up to $9,600 a year. So if you sum all of those, or what cell E8 is doing is simply a sum of E3 to 7. So it sums everything above it up. So the gross income for that family is that amount, 150K. Now, there are taxes. In these cases, these numbers are not real. They are just something that I used to do the calculation. Okay, federal withholding tax, the Social Security, Medicare, state. There's a state tax. In Texas, we don't have a state tax. So if you're doing this in Texas, that cell will be 0 for you. But in the other states, you will have a state tax. And you put all of those in. Now, I've had people that I don't know what this is. How do I find this out? Take your pay slip and walk through it. See what the numbers have been. And even if your income are not the same, you can average the numbers over a period of 2 to 3 months and come up with an idea. A budget does not have to be exact. It's really just a tool to give you an idea of what is going to happen. All right. So at the end of the day, the income after taxes is that 150 cell E8 minus cell E14, which is the taxes. That's your income after taxes. For a Christian, we pay tithe. The tithe is 10% of your gross. I know there are people that argue around 10% of gross or net. That's not the intent of this session. My understanding is use 10% of your gross as your tithe, which is what I used here. So 15%, 15,000 is 10% of the gross over there. I also ask people, I tell people that please plan your offering, pledges, gifts, you know, and things like that. Other things that goes out from you, or first fruit. God can give you something you want to pay first fruit, you know, those different ways you give in the kingdom. Now, you can have a different role for charity. You can have another role, add a row in there, put it as charity or something. And then you simply draw down the formulas, it will calculate across. So if you add all of that up, it ends up being 18,000 between tithes and offering in this example. It's 18,000. I think so. Let me allow this person here. It's 18,000. And then if you keep going down, sorry, my mouse is behaving a little bit funny. So I'll just keep going. Then you have other expenses. In this case, I have here insurance separated from other general expenses, medical insurance, dental insurance. In this part of the country, these are expenses that you're going to have. Okay, your vision, if you have, and I do recommend, you know, we talked about that a little bit the last class, life insurance, term life insurance particularly. Okay, total insurance for this individual or this group was this amount. And then there's a row here for what is the individual's 401k. And we're going to talk about this. This is going to be the focus of tonight. The various investment vehicles will be the focus of tonight. So we'll get into that in detail. But I use 5% of this individual's income as their contribution to 401k, and it ends up being 7,500. Now, the deduction, if you look at that cell, the formula at the top of it, sorry, I'm not sure why my mouse is behaving the way it's behaving right now, but the formula at the top of it, you know, the formula in cell E7 essentially adds up all the various, let me use the cursor to go to it, adds up, you know, all the various subtractions. Okay, E14, 25, 19, and 26, they are all deductions. So the total deduction, you just want to have a feel of, even though I made a gross of 150, what are those deductions that I really don't have control over? It's not money that I have the opportunity to spend. It's going to go out of me for various things, either tithes, taxes, medical insurance, or various types of insurance. You know, you have that in this case 46. So 46 out of 150 puts you at 104. This is your earnings after your taxes, your tithes, or another form of deduction. And that's what you have control over in this example. Whatever your number is, you should be able to pick that out of it. Now, all you now need to do after you've gotten to this point is to identify, and I tell people this is probably the most important part of it. Every bit of thing that takes money out of you must be identified and listed. Everything. What I have listed here may not be comprehensive for some people. It might be. And for some people, it may even be more than they have. And that's fine. And on that first row there, B30, I have housekeeping, you know, groceries, eat out, whatever. You can break that out even. Rent or mortgage, shop. In this example, you remember I said they have like a side hustle. So I put a row for, let's say they're renting a shop to accomplish that side hustle. House maintenance and home improvement, car note. If you have a car note, you know, credit card payment, car insurance, everything, student loan, electricity, water, gas, entertainment. If you're paying for like Netflix or TV, internet, Spotify, you need to have it all listed. If not, you'll be bleeding and you will not know where you're bleeding. You need to plan what you spend on clothing. Don't just go to the store and spend an amount and not know if you can truly afford that amount or not. Your vacation, can you truly afford to go on that vacation or not? Now, your vacation will be planned on an annual basis, but you need to break it down, like I said, to a monthly value. You know, let's say in this example, they say, okay, we're spending 6,000 out of our income for vacation. What does that mean? That means you accrue 500 every month. For 12 months, we pay for that vacation. How much do you spend on gas? How much do I spend on, let's say, copay or gym membership? Miscellaneous expenses. Always have a line for miscellaneous, and your miscellaneous should not be more than 1 to 2%. I tell people it should be something that really is truly unexpected and have it budgeted for. Okay, so in this case, you see how quickly it all adds up. This individual had 104K, or this couple, now 98K has gone out of it, and it's down to 7K or 6,700 that they have left over to do whatever they want to do. But the point is, knowing that helps you to know what can you truly set aside. Imagine if this same couple, that at the end of the day, what they have left over is 104. Let me make some changes to these numbers and say, okay, they really went to buy a house that is costing them double this, or maybe 50% more. So it's costing them $3,500 a month. See how that quickly changes the dynamics. They went from 8,000 in the positive to 6,000 in the negative, from 7,000 in the positive to 6,000 in the negative. I hope you see the point I'm making there. Simply because they bought a house and every other expense was not changed. I can undo that and show you what I mean. If I undo that, they were in the positive 6,700 when they owned a house that only cost them $2,000 a month, or a mortgage, either a rent, whatever. But this same couple did not know that that is all they can afford if they want to have something left over. And they went and bought a house that started costing them $3,500 a month. Immediately they go negative. Now this couple cannot invest. They have nothing left over to invest. In fact, they will be borrowing money. These are the kind of couples or family or individuals that have to depend on credit card on a month-to-month basis. And you know, the sad thing is, when people say, I don't even know where the money is going, because you never sat down to write the vision down, to really detail what you want to spend money on. As a result, you're not going to know where the money is going. You're not going to know what is costing you that you can truly cut down on, or should you change that. Now, maybe someone is already at that spot. Now you find yourself, let's say this is you, and you already bought the house that cost you $3,500. The question is, what then must you do? What can you do? You then need to look at other line items and see what can you cut. You might say, in this case, look, this shop rental, I'm going to look for another shop that costs me $300 a month. So that starts changing the dynamics. It puts 2,000 back in your pocket. You want to say, look, this credit card loan, there's a dynamics to managing credit cards loan. Because of time, I won't go into the details, but I always teach people. In fact, if you look at people that teach along these lines, even if you have a credit of 200,000, don't try to bite it all at the same time. You're going to put yourself in trouble. And don't join the group that they tell, come and consolidate into one credit card or one credit. Those people are scammers. They are going to steal from you. They don't have your interest at heart. And it even doesn't work very well in practice. If it's, the way to go about it is you take the smallest amount that you owe. Let's say you owe on 3 credit cards. You owe 500 on one, 6,000 on one, and 13,000 on another one. The one that you owe 6,000 and 13,000 on, those are not your first priority. The one that is the smallest, the 500, that's where you start. You pay that off, and whatever you are applying to that, you start applying to the one that you owe 6,000, because you paid the first one off. After you've paid off the second one, you pay off the third one. That is the way to get out of debt for those that are in credit card debt. But anyway, this individual has been paying $900 a month because he's trying to pay it all at the same time. There's no need. Figure out what you need to pay. You can even restructure these things with people, with the various organizations. Let's say he's able to restructure it and limits his payment to just $400 a month, and immediately it turns positive. Now, even though he's still owing money, he now has close to $2,000 a month. He or she or the couple now have close to $2,000 a month that they can save, they can invest, they can set aside towards other investment, future plans that if they continue to do the way they were doing, they wouldn't have been able to achieve. So let's assume that, there's someone in the class that's saying, look, I've already bought this house, and so what am I going to do? Does it mean after I look at my sheet and I'm negative, there's nothing I can do? No. What you will need to do is what I just explained. You go back and think, okay, I'm not going to get out of the house. Maybe that's an option. I tell people to downsize if you can. Maybe that's an option, but if that's not an option for you, you then need to look at all the line items and look at where you can cut to the point that you end up in the positive at the end of the day, no matter how small. Remember what we shared the last time, the power of even $60 a month, $50 a month over time can be very, very tremendous with the power of compounding. So it's not the size or the value, the amount that you set aside, the fact that you do so consistently over a long time, that is the key to success in this respect. Okay, so that's how the sheet works. And then at the bottom here, you now have, let's say in this case, the individuals have been able to make some adjustments, and now it has like 1900 left, and it's going to say, look, so that I always have a little bit of money, for things that I didn't plan for. I'll put $200 a month into a savings account. And I also tell people set up different accounts for all these different things. I have a saving account, I have a checking account, I have an investment account. They all have different purposes. I have an account where you're putting money in to buy a house, to replace your car. You can set up various accounts under even a main account. All right. So, but in this case, using this example, this individual or this couple said we will put $200 a month aside as our as our savings. But because of our goal was, if you again, I'm not going to go back to that. Let's say when they use the future value spreadsheet, they discovered that their goal to achieve their million, 2 million, 3 million, whatever the number is, in 30 years, in 40 years, whatever that time frame is $1,000 a month. Then you put here, okay, $1,000 a month. You put that in that column. So you can see that it's summing up for you what you're spending, in the process of your savings and investing. Now, the car replacement, we say, I have a car, but when I replace this car, I don't want to take another loan. So I'll put $300 aside. It sums up now to $1,500. And, if they don't have a house, in this case, I'm assuming this couple have a house. So, so that cell, they don't need to put anything. You can have another one. You can put depending on what you're trying to do. But the point I'm making is this. This couple can actually see on paper what is left. Anyway, what is left and what they can spend money on. And they see that, look, even after investing and saving, I still have a total of 1930 minus 1,500, which is like 430, that doesn't have, it's not set aside for one thing or the other. So you have a little bit of buffer is really the point. And the way this spreadsheet works is that it calculates everything for you, and it helps you to then go over here to the expenses section and begin on a monthly basis. And I always tell people that this is pretty important. It's one thing to plan or to budget. The next thing is then to now put in the actual. Let's say for the first month, instead of 6,000, you made 5,800. Go ahead and put it into that cell, and it starts summing up in column R your total. So that at the end of the year, if this is the first time you do it, it's not going to be as exact. But at the end of the year, you can look at column R and see what the numbers are. And then that becomes your real budget for the following year, or helps you to guide your budget for the following year. Let's say for the first month, the wife made actually 4,300 instead of 4,000. It sums up the total also at the bottom in cell F8. The business income, let's say they made 1,200 instead of 1,250. Bonus, they didn't find any bonus that month because their bonus is paid only once a year. And then they did not make any other thing. So for the month, they only made 11,300. Okay, and then whatever you pay in taxes, you just go ahead and put all of those in there. Again, I won't spend too much of time on this. It's actually very intuitive. My point is, make sure you put the actual back in. That is where reconciliation comes in, because it helps you to then go back when a month is higher or lower. You can ask the question, why is it so? Now, this takes time. whatever is worth the while takes a while. If you're not going to do this, I can assure you, if you're not going to spend time to do the reconciliation, I can assure you, you will lose control of your finances. You will. Now, different people do this differently. You can sit down and reconcile once in a week, once every fortnight, once a month, whatever makes the sense to you. However you can do that, you need to be able to do it. And our younger ones have tools that they can kind of actually use. There are some very good software that can do this for you. There is Quicken is one of the tools that can do that for you. You will need to pay a little bit, but it can do it for you almost automatically to do something very similar to what I'm doing. Calculate your actuals, calculate your percentages, and you can do a evaluation of your plan versus actual, so that you can see where you're going, more than you thought, or where you can, be a little bit more flexible on yourself. So it's a spreadsheet that I feel will be very helpful because it helps you to see line 53. Line 53 is where you want to see, which most people do not see. Line 53 is what tells you your net income. That is, after all your income. Imagine these individuals, they made 150,000. All they could have, at the end of each month is 2,000, which puts them only at 11,000 for the year, 11,300, as you see in column R53, in cell R53, I should say. No, sorry, in I'm not sure if I summed that up. Anyways, the point is about 2,000 a month times 12 will give you close to 24,000 in this case, as what they will. Actually, this is the annual. I'm sorry, I'm looking at the annual and multiplying it by 12. What all they have is 162 a month, which at the end of the day, even though they make 150,000, all they can set aside is $1,900 for the year. But again, it's not negative. It's a place to start, and they can say, okay, of that 1,900 that we're going to have left over, remember, this is the column E is your annual. I was kind of getting that mixed up there. The columns E is your annual, right? So the 200 is what they want to set aside every year. The more you have, the more this number can be. If you want to set aside 1,100 a year towards your goal, the question is how much is that on a monthly basis? You can put a calculation in column C to the left of that and say, oh, that implies X, a month. And that's, you set it aside and you can invest it on an annual basis or a quarterly basis or whatever frequency makes sense, sorry, the way the cursor is working, I think is because I have this in, the Excel open and the PowerPoint open. I think it's just working funny for me, but I can do a calculation here and say this is that divided by 12. Okay, so saving less than $20 a month, I can copy that down and see and show you what that means on a monthly basis. Oops. Control C and Control V that. Okay. All right, there's a circular reference in one of it. But anyways, you can see, for example, for the money being set apart for investment on a monthly basis, in this case, is only $83. Now, if that is what you had obtained from using that future value spreadsheet, that's fine. You already said what you need is $1,000, or let's say what you want to do is $1,200 a year. Column E is the annualized version. So you know that what you need is really $100 a month to accomplish your goal. This is where you work it out, and then you then take that into your planning sheet again and say, okay, is what I have in the long-term plan, future goal, future value, spreadsheet, the compounding spreadsheet, does it match what I'm able to do here? If not, then you need to work on these until you are able to set aside what is needed in that future value spreadsheet. I hope you all remember what I'm referring to as the future value spreadsheet, which is this sheet. Let me open that in Excel again. For the sake of everybody, that's this sheet, which you have in your, we have this sheet on the on a WhatsApp chat, right? In this example, I said $60 a month. See the power of $60 a month in 60 years, $2 million. I mean, $60 a month is, I don't know, how much is that a week? $15 a week, or $2 a day, less than $2 a day. Now, somebody might say 60 years is too long. This is just an example, right? 30 years in this case is 195,000 of $60. But in this case, if you go by that example, you'll put $100 in this green where I have 60, and of course that will be 1,200. So my point is, if this was your spreadsheet, you will then say, okay, does what you have where I have 60 right now, the monthly amount, does it match what I see on this cell? If what I see on that cell is 200 a month, then I need to figure out how to get to 200 here in cell C58. I hope that makes sense. Once you get all of that together, then you're ready to truly start investing. That's why this is so core, so critical to investing. So I'm going to stop at that point. I've been talking for about 45 minutes. I want to open this up to a question, and see if anyone needs me to clarify something on what I just said. Any question from the audience? Let's see. This is 100. This is. Any question? If no question, that means you all understood what I just explained very, very well. Correct? I'm hoping so. And in this example, okay, my cursor is back up now. So this individual, after he has, he has this leftover at the end of the year. It's 162 at the end of the month. It totals the things that he wants to set money aside to do. Let me actually open the spreadsheet and maybe plug that number into it and show you what it means quickly. If $100 a month is what you're able to set aside, let me quickly open that sheet. Give me a minute, please. I want to actually open the compound interest spreadsheet. I hope I get to that thing I just opened now. All right, so this is where you compare these two sheets together. This worksheet helps you to plan your expenses so that you have something left over. In the case of these people, all they have left over is $1,900 a year, which amounts $162 a month. And broken down for them, they must have started by saying, look, what I need $100 a month will get me there. So that 100 is 1,200, right? If this is what will get them there. And what that does is $100 a month in 35 years will give them a 10% rate of return, $325,000. Let's say 35 years, that's where they want to get to. That's how you work it. So you start from this point, you know these two numbers, your monthly and the annual, which is essentially the same, times 12. That is where you start from. Then you go to your spreadsheet and you figure out how do you get those set aside so that you can accomplish what you have on that future value spreadsheet. I hope that makes sense to everyone and you appreciate what I'm saying there. Because once you do that, then you can then go back to your sheet and say, okay, now I know how to plan my expenses. I know how to reconcile on a monthly basis, and I know where I'm going to get to. And I know that by doing X, Y, Z, I will get there. That's what you've just done by taking all of these steps. Now, I will share that spreadsheet with the group. If you've not been in the session before, I strongly recommend that you take some time and do what I just did. And if you have questions, feel free to reach out to me. Once you've done that, you've now been able to say, look, I know, like in the example of this couple, I want to achieve X amount, and I will achieve it by doing A, B, C. Now, the question is, what do I put that money into that can give me that long-term return. This is where we then get to the core of tonight's class, which is various types of investment vehicles. A vehicle is something that takes you from one place to another. So there are various types, and I will just go ahead and start talking about it right away. The first one, which I also spoke about the last time, is investing in individual company stocks or shares. The first step to be able to do this, if you haven't done so, there are some people that are joining us for the first time that you may not have an investment account or a brokerage account. Please do yourself a favor, do your future a favor by opening an investment account, a brokerage account. Not a lot, practically everything apart from direct real estate investment, which we'll talk about next class, we won't get to today. A lot of all the various investment vehicles that, apart from an investment done through a company that you work with, every other type of investment vehicle that I will go through today, you can invest in through a brokerage account, an investment brokerage account. One of it being stocks. A stock, for those that are not very familiar with that word, means a part ownership. A part ownership in a company. That's what a stock is. In the older days, they actually had to go into a physical building and they'll issue you a stock or a share certificate. Another word for a stock is a share. They'll issue a paper to you that shows that in this company you have this. Now it's not like that because of technology today, but those things are still held for you in the what's it called, by your broker, as it were. Okay, so that's what a stock is: a company share and a unit of ownership in a company. And I spent some time last week to explain the fact that stocks are one of the easiest ways to build your investment over time, as long as you're not one of those that is looking at it as a short-term thing. It's one of the easiest or most proven over the years ways of building your assets, your investment over time. And the chart that I have on the top right, I explained it to us then. But the key to it is really to maintain a long-term view, which is what the black chart at the top shows. If you maintain a short-term view, you can see the chart in red is actually a normalized version of the one at the top, which kind of puts everything back to the same time frame, on the same datum of 0. What happens if you're just maintaining a short-term frame is that you will lose in the short run. You can be assured of that. You will lose in the short run. If you maintain a long-term frame, you are going to be successful in the long run. And there was this study by Charles Schwab, which is one of the investment brokerage firms. This was done, it's a little bit dated now, probably 10 years or more ago. Actually, it looked at 5 people that were investing $2,000 a year per year for 20 years, starting in 1993. So that means you're 2003. For 10 years, 5 people. The investor with the best timing, that is, always hits the market. If you think about these charts in red and the top there, it's always hitting the market at the bottom when it's at the bottom, and it rides the wave to the top. Always tends to hit at the best spot. His return was 87,000, even though all he did was hit the best spot. The guy that got the worst timing, look at it, that is, if he always bought at the top of the market. I hope you can see where my cursor is pointing. Actually, you know what, let me see. I think I can use a pointer. Yeah, I can use a pointer. I should have been using that. I should have used that earlier on. But anyways, the guy with the worst timing, that is, he always tends to come in at the top of the bad cycle. When shortly after that, things go south. Always tend to come in at the top. He still made, just by staying in the market for that 20 years, he made 72,000. I mean, think about that. Whereas the guy that stayed in cash, that is, he chose not to invest, he made just a little bit He kept all his money and in some kind of cash type account, savings account yielding 2% or whatever, or just money market. He got 51,000. You know, the point is, even the guy that didn't perform well, as long as he stay in the market, he made like 30,000, 20,000 more than this guy on an investment of 40,000. The total investment or contribution after 20 years is 40K. He still made 21,000 more than this guy that kept his money in cash. And I explained to Ross last time that even this 51K, if you really think about it, it's actually less in real terms. You remember when I was talking about present value, future value, and the impact of inflation? In real terms, this 51K I will have to calculate, depends on the inflation, may not even be keeping up with inflation for wherever this individual was that kept cash, right? So what is the moral of the story? Don't wait on the sideline. You will miss 100% of the shots that you don't take. That's very, very important to keep in mind. Your goal when you start investing in company stocks or whatever it is you invest in is what they call asset allocation. And I will explain that a little bit more. And diversification. Those are the key to successful investment: asset allocation and diversification. I really want to stress the fact that you can't win by sitting on the bench. As with anything in life, fear is not rewarded. Only courage is. You know, sitting on the bench means people are afraid, especially in a lot of some of the cultures that I see. People are afraid. They say, the stock market is, I tell people what is risky is the fact that most people truly do not understand what they are doing. If you understand it and you follow simple things that I've explained in the course of this last class and today, it's really not risky. You know, the goal is maintain a long-term, focus. If you operate in fear, you've already lost even before the game began. I want to stress that as much as I can. You know, your goal is to make sure you educate yourself, which I'm glad you're on the line, you're trying to do. And you're not investing in people's ideas. Don't go and if somebody comes to you and say, there's this idea, if you put $10 into it, it will make you $20. Don't listen to those kind of people. They are scams or ignorant. It's one of the two. Don't invest in people's idea. Invest in proven items, proven businesses, proven strategies, and maintain a long-term view. That is your goal. Okay, so that's a company stock. You buy it through an investment brokerage account. That's the first level. The next level is to invest through mutual funds. Now, a mutual fund is really a pool of money that is collected by an organization, and it is invested in more than one stock. So earlier on, in the first instance, individually you can buy individual company stock, like a stock of Apple, a stock of Microsoft, a stock of Walmart. But rather than buying individual stock, you can actually put the same $400 you have that you could have used to buy just one pieces of those companies to buy into 50 companies, just a fraction of the stock, by buying a mutual fund. Now, mutual funds are very good. The only problem with mutual fund is the cost of ownership of mutual fund. Because those that manage mutual funds, in many instances, they have to pay for the office that they run. They have to pay for the staff that help them to do the research so that they can help you to invest. They have a lot of expenses. They have a lot of costs that they will pass across to you. Mutual fund also tends to want to trade the stock with the intent of beating the market. When you do that, I hope I've already explained to us that that's really not what you want to do. You want to perform as good as the market, not necessarily beat the market. By trading, you subject yourself to taxes, and taxes plus the cost of buying and selling of a stock raises the overall cost of running a mutual fund. There's what is referred to as net asset value, which is the way a mutual fund is priced. Mutual funds don't get sold like every minute, every second as a stock is. If you have an investment account, you see that, you know, stocks are sold in microseconds, bought and sold hundreds of millions of dollars every microsecond. Mutual funds are not like that. They are traded based on the overall value of what is in that stock at the end of the day, which is called, I will show you the calculation of net asset value in a minute. So anyway, mutual fund is a collection of money that is invested in multiple stocks that is referred to as, you know, the money put in that is called a fund. So it's called mutual fund. So the third investment vehicle, which is what I want to recommend to everybody in this class as your strategy for investing, is what is called an index fund. An index fund is a type of fund. In a sense, it's a kind of mutual fund because it does what a mutual fund does. It pulls money together of multiple people so you can afford to buy multiple companies, right? And put it into a portfolio. The only difference between a regular mutual fund and an index fund is that they are not trying to trade to do better than the market. They simply buy stocks that are represented by a particular index. You hear the word Dow Jones, the word S&P or Standard & Poor's 500, NASDAQ, and a number of other indexes. What an index is it's a group of stock that has been created that for you to be included in that group, there are criteria that your company needs to meet. For example, NASDAQ is an index, and all the companies in the NASDAQ are technology focused. They might have a few that is not directly technology, but they are technology focused. Apart from that, the company must meet certain criteria in terms of their market capitalization and a number of things. So for you to be in that group, there's already a process that those that put the index together went through to include you in that group. So as a result, the group doesn't change because for you to be there, you have to meet a particular criteria. They already decided the companies that are in that criteria. So what does that mean? Those stocks don't, the list of companies in an index fund doesn't change really for a long time. Now, if a company then falls in performance compared with whatever the criteria for being in it is, they will take it out of the group and replace it with another company that meets that criteria. But that does not happen very often because this company really keep, you know, their performance to a large extent. So S&P 500, for example, is a group of 500 companies that cut across various sectors, selected by Standard & Poor's, which is a standard organization, a financial standard organization. So those 500 companies meet, or, you know, they've met the criteria for being among the 500 companies. So they are the only 500 there. And if a company falls out, they'll take them out and put another one. So my point there is that since it's not changing, there's no trading going on. If you buy an index that mimics or mirrors an S&P 500, the stock is not going to change. The group of companies in the index is not in the fund is not going to change. So there's no cost of trading. One of the things that eats people's money or investment money is taxes. When you trade your stocks in less than 1 year, you pay a higher tax because it's considered trading rather than investing. You pay a higher tax. Okay, so because it's already representing a benchmark, you know, or a group of index stocks that met a benchmark that had been set by the index, there's no need to trade them. So you don't, the stocks don't really change year to year. So you don't pay all the trading fees and you don't pay all the taxes that goes with it. There's what is called expense ratio, which is all those cost of managing plus the taxes and everything that the company has to pay. Look at the table that I have on the right. The average index fund expense ratio is less than 0.1%, 0.09%, whereas for a mutual fund, it's about 1%. And that looks small, but let me show you what that means. It looks small at 1%, But because it's taken out of your capital, is not allowed to compound. Look at the difference. This is an example. After the fee effect of these ratios or this expense ratio of an investment of $1,000 a year, if your investment is earning 7% return over a 30-year period, because of a smaller expense ratio, that's money. What you put aside of $1,000 annually is about $30,000, but after 30 years, it's $99,000. Whereas mutual fund, every other thing being equal, you will lose $13,000. That is a huge, not amount of money to lose, to fees that you don't need to pay. That's significant loss. The point that is being made at the bottom here. A significant loss. That's money that never got to compound for you. That's why I always tell people, you don't need to even invest or spend time, which is part of the reason why I took the portion on trying to help people understand how to do this stock charting and all of that. There's really no need for it. For some people, it might be good, but not for everybody. You don't need to spend your time looking for stocks. You shouldn't be investing in mutual funds. You should be invested in index funds. All right. If you have a question at any point, please feel free to raise your hand and I can explain. Net asset value is what is used to calculate the price of an index or a mutual fund. And what it is, I see your hand raised. Tamilana, yeah, go ahead.
Sorry, sir. I just want to clarify. So with the index funds, this is not just for like the 401k, right? This is for regular investing too.
Yeah, it works for both. So I will get to 401k in a minute, but when you hold a 401k, make sure that the money you have in it is not invested in mutual funds. It's invested rather in index funds because it's the same thing that's going to happen. The expense ratio for the mutual fund that you're putting your money into is going to be higher than the expense ratio of an index fund because the mutual funds will be traded on a shorter term basis than an index fund. And what that does is that you pay cost of trade and then you pay taxes, which eats out of what you have to compound, leaving you with a less value over time. I hope that makes sense. So the principle is still correct, whether you're in 401k or a direct investment. There was one of the students in the class, when I taught this, he went and looked at his 401k in the company that he's working with and realized that his money was placed in mutual fund and he converted it to index fund. And he said almost immediately he started seeing the difference in the value of the 401k. So strongly recommend to review what you have in your 401k. And I'm going to talk about 401k in a little bit. Please review what you have. Make sure they don't have your money in index fund. In fact, some of the companies, they put your funds into the company's stock. 100%. In most instances, if not all instances, if you don't tell the company, unless it's not a publicly traded company, they will put all your money into their own stock if it's a publicly traded company. That's the way most 401ks work. But you have the power to say, put X% in the company stocks and Y% in index fund or mutual funds. So if you don't do that, they will put 100% into their stock. And that may not be bad. Excuse me. However, you're putting all your eggs in one basket. Remember what I said earlier on. The key to successful investment are two words. Two words. If you don't take anything out of this class, take this with you. Two words: asset allocation and diversification. The moment your funds are left in the company, you're no longer diversified. There is no asset allocation going on at all in that case. All right, I see another hand raised. Stanami?
Yeah, but Larry, what about college fund 529B? Because I used
Yeah,
to think that for that, mutual will work faster, being that it's a short time turnaround than
no,
index.
no, don't put your money in mutual fund. It's the same principle. I wish I can say this enough to every one of us. It's the same principle. There is no mutual fund that is not traded. Every now depends on the fund manager. The fund might be traded, by some managers more than some others. Sorry, I think there's some echo from you, so I'll mute you for a minute. Or if you don't mind, please mute yourself. Okay. Um, uh, Almost every, you know, uh, um, I lost my thoughts there. But anyway, I guess the point is, yeah, okay. The point I was going to make is that almost every mutual fund is traded more than an index fund. That is why the expense ratio will vary by fund. You can see a mutual fund that the expense ratio might be 0.8%. So this 0.8% or 0.82 is like an average based on the study that was done by S&P, by Charles Schwab. There are mutual funds that have expense ratio as high as 1.5% to 2%. And I will show you what that means in a minute. So it doesn't matter if you have it in 527 or college funds, and I'm going to talk through all of those as well this evening. Please use index fund. The reason is because it's not traded. If it's not traded, there is no tax to pay. There's no tax to pay. You have money left to compound. And then if it is not, even though generally speaking, you don't owe a tax on a 527 or a college fund when you take it in future. True. But when if they trade the elements, the elements of the stock, tax will be paid by the fund company on your behalf. You don't owe a tax when you withdraw it for school, for the children in the future, but the process of them trading it, they have to be taxed for it, depending on the timing of how they held it for. The worst is if they bought a stock and they sold it in less than 1 year. It attracts the highest in tax rate. So I hope that answers or helps you, Naomi. It's really very, very
Yeah,
important.
thank you, Bro Larry. Yes.
Yeah, excellent. All right. Now let's go to the net asset value, back to net asset value. So net asset value is the way a mutual or index fund is priced. So the easiest way to explain it is, imagine if an index fund has 10 companies. Those 10 companies will have different prices. Let's say one is sold for $10, one is sold for $50, one is sold for $100. So what price will they sell it for? They have to use a weighted average. And the way it's calculated is they look at the asset of the fund management company, subtract it from their liability, essentially calculate what in accounting terms is called the equity of the company, of that fund, and divide it by the total number of stocks that they own of the different companies. So the equity of the company divided by the total number of stock is what is called the net asset value. Essentially, dividing their equity by the total number of stock gives them the equity per stock, which is the quoted price of a mutual or index fund. And I will show you an example in a minute. In fact, I'm going to give you that example as an assignment for tonight. I strongly recommend when I give an assignment that you please do it, because that's really the way to internalize what I'm talking about. If you don't do the assignment, you cannot truly internalize it. It's still kind of like nebulous in your mind. But when you do the assignment, some things are not going to be clear. The process of walking through it will help you. And if you have questions, like I always say, please feel free to reach out to me. I will explain. So anyway, the net asset value, you will see it is what you will see that is quoted for an index fund. And then another thing is what they call the portfolio turnover rate. So you'll see a term like AUM. When you look at the prospectus of an index or a mutual fund, you'll see what they call AUM, which is the asset under management. If a company is managing a total portfolio worth 100 million, AUM, I don't know why they just accountants and all these financial people, they want to confuse people. they want to make you feel like it's difficult. AUM, they will not say portfolio or total asset. They will just say AUM. That's what, if you listen to financial news, that's what they will say. All it is the total value of the assets in the company's in the fund's portfolio. That's it. So if they have 10 companies and the value, everything is 100 million, that's what the AUM is, the asset under management. If the portfolio manager trades 20 million of the securities during the year, then the rate of turnover, which is what is called portfolio turnover, is 20 million divided by 100 million, or 20%. Again, I'll give you an homework or an assignment that will help you to see this example. If we have time, I may actually open one prospectus and show you what I'm talking about. But it's important that you understand this, because that's how you evaluate which funds you select or not select. You need to look at the expense ratio. You need to look at the NAV, the turnover rate. Okay. Okay, the expense ratio, the all-important expense ratio. This is the key. The number one you have to look at is expense ratio and the turnover ratio. Those are the two key ones really that you need to look at. And I've explained what the turnover ratio is. The expense ratio is the cost of managing the fund and paying your fund managers, because they take their salary from you. If they have to manage a lot, the management fee is paid to the fund managers, who decide on how to invest the money. It's almost like an advisory fee. They have administrative fees like office, administrative staff costs, money for managing secretary, managing office, and then they have advertising fees. All of those put together is all what comes into your expense for running the company. Imagine if that company has 100 million in AUM and they spend 1 million a year, 1% automatically goes as their expense ratio. So that's what that expense ratio, the 0.09 and the 0.8 something that I showed you earlier in that table, that's what it is, the expense ratio. It's their management and administrative fees and all their marketing fees. You also see terms like gross and net expense ratio. So simply put, really is, the expense ratio is the cost of running the company or running the fund. There are some temporary discounts that may not be applicable all the time, whereas sometimes it's applicable. So if that is included, it will be gross. So simply put, a gross expense ratio includes all explained in what I explained in the last slide, whereas there might be other expenses that may not be always, it might not be a regular expense that it will be at every year. So you might see a fund that will quote both a gross and a net expense. That is, even though our normal expense ratio is 0.1%, for this year it's going to be 0.3 because we're going to have this extra added cost that we normally don't have every year. So you want to look at those two numbers. If there's a big difference between the gross and the net expense ratio, they're not doing something right. Their expense ratio should be very close, gross or net, on a yearly basis. It shouldn't be swinging. If not, they're cheap. I don't want to say they're lying. They paint that the gross expense ratio is X, but really their net expense ratio is higher, because they spend other money that they don't want people to see that they are spending. So, but if both are pretty much the same year over year, that means what they're advertising, they're not spending any extra to more than that. Okay, it's very important to understand those two terms, because sometimes they will just quote the gross, whereas their net is higher at the end of the day, right? I hope that makes sense. I want you to take a note of that. And that's what I'm trying to say in the blue. On the other hand, I say the gross expense ratio shows what the investor will have paid without the additional, fees, fee waivers, and what the investor can expect to pay in the future if the discounts are discontinued. So anyways, really, if you spend they spend some other money more than their normal expenses, then there's a difference between the gross and the net expense ratio, you know. Okay. I said something here that the expense ratio that you want to be looking at should be less than, 0.5. It should not be more than 0.5, because if it starts going above that, it's going to eat into what you have to invest. Okay. I don't know if I think I might have mixed gross and net a little bit up earlier on. So if they put some more money, if there are some expenses that they took out, which they shouldn't have, then you have, the gross and the net that will be different. That is, if there are things that are non-standard, it's what will cause your gross to be higher than the net. It's really the point I'm trying to make. Okay, the lower your expense ratio, the better. Preferably less than 0.5. I always look for something that's actually 0.1 or less. At the most 0.2 is what I'm always looking for investment. On the other hand, mutual fund will typically more than 1%. You saw the average earlier on 0.8 something. Okay. Now let me show you an example. Okay, and I think I talked through this. Not I think I talked through this, that high expense ratio is very typical for a mutual fund. These are the negatives of a mutual fund. 1 to 2% expense ratio is typical, which is money you don't get to, that doesn't compound for you. Turnover rate is usually higher because they are trading, Index, on the other hand, is based on a portfolio that is fixed. Now, this is to explain the impact of high fees. Look at this chart on the left on my screen. This is the impact of investing 1 million at 8% annualized return over 30 years. 1 million, after 30 years, if my expense ratio is 1%, this is now the total expense ratio now, the gross. Remember, that is the key, the gross. That's what they will use to calculate all your expenses. If the gross expense ratio is 1%, that money will grow to 7.6 million. Look at what happened by just increasing it by 1%. You lose almost $2 million simply because of 1 extra percent. Add another percent to it, it's essentially loses another 1.4 million. So you go from 7.6 to 4.3, losing 3.3 million over that period. That is the impact of expense ratio. The reason is because what an expense ratio does is it takes money out of your pocket that does not have an opportunity to compound. That's the problem. The money leaves your account. It's used to pay for some fees or pay salaries, so it doesn't get to compound for you. That's why it's so negative to invest in mutual funds rather than index funds. This is another view of the same subject. Look at this example. Based on 50,000 initial investment in a particular portfolio, let's say the 7% is the gross return. Yeah, that means the return on 50,000 is 3,005. 3,555. That's the gross return on that 50,000, right? If you calculate it, you'll see that 7% of 50,000. If the expense ratio is 1.25%, that is 1.25% of what essentially 1/7 of this amount becomes another expense, which is 600. Another 1/7 becomes another 600. So what do you get at the end of the day? 7 minus 1 minus 1, or 7.1 minus 2.4, or something in that range, brings you down to this amount of 3,000 minus 600 brings you to 2.3. And if you calculate that, the percentage is not exact essentially. If you calculate that and put it on your 50,000, it amounts to 4.65%. But the point is, your true fees is in addition to, the quote's just 1.3%, right? As your expense ratio, but 600, another 600 divided by what your gross return is, it's actually a third, of what you will have made that has gone to fees. So the more this amount is kept low, this 1.2%, 1.2%, the more you can keep it low, the less. So if you can reduce this amount that they are taking out of your 3.5, then the less your actual fee effect is. That is, 34% of your money is not allowed to compound. It's taken out of your account. Is what this is showing you. 34%, 35% is taken out of your account by just this 1%, 1%. So when you see them quote it as 1%, 1.2%, the point is it's a large amount at the end of the day, because that money is never allowed to compound. Only 2/3 of your gross is compounding for you. I hope that makes sense what I'm trying to explain and what this table is trying to explain to us. It's why you want to keep your fees down. And that is what you see the effect of it in this particular chart here. Look at these charts. Let me just look at, a 5-year and a 10-year chart of an index fund in blue and a actively managed mutual fund. When you hear the word actively managed, it means they are always trading the stocks. It's a mutual fund. Look at it, over 5 years, 9.5%. And this is based on the study over 5 years that ended in 2019 December by Charles Schwab, comparing a group of managed funds and an index fund that Schwab runs. 11 points, and that's significant. Over 10 years, this is 11.8 and 13.5. This difference of 2-point-something% is huge. It's huge when you think about the power of compounding, which I've explained to us. Okay, so that's why I always tell people my recommendation, you can do what you think makes sense for you, but my recommendation is use index funds to reduce the cost. All right, I hope that explains the difference between mutual and index funds. And then there's what they call an hedge fund. An hedge fund is even a little bit more challenging. So in the first place, not everybody has the privilege of participating in a hedge fund. You need to have a particular capital capability as what they call an accredited investor before you're allowed to invest in hedge funds. The goal of hedge fund managers is what they call seeking alpha. They're seeking to beat the market. Alpha is performance that is better than the market. When investing terms, the word alpha means doing better than the market. The word beta is you're meeting market performance, So below beta is less than, market performance. That is, if the market is doing 10% annual return and you are able to make 13% annual return, your alpha is 3. You are seeking that delta, that incremental return. Or if somebody else is doing 8%, then they are doing less than the market. But anybody meeting the market returns is said to be meeting, to be doing beta, as it were. Okay, so the goal of an hedge fund is to aggressively invest. They are looking for various investment vehicles that will perform better than the regular market return, as I've shown us over the last few sessions. So they use different tools, and I will talk briefly about some of them: derivatives, what they call options, leverage debts, and stuff like that. It's really if you have very good fund managers, they might do well, but very, very few of them exist. And not a lot of people have the funds to invest in them. So generally speaking, this is more of an awareness for us. It's no use trying to beat the market. Some try, but not very few people do. Now, the next one I will talk about is your company-sponsored investment or retirement plan. There is what is called the 401k. So the term 401, 403, 405 is really the tax code for it when it was created. That's all it is. So for private companies, the company retirement plan is referred to as 401k. For public schools or tax exempt organizations like some hospitals, it's called 403b. And then 457 is really for like state and local governments, organization, non-profit organization. But essentially, it's the same thing, pretty much the same. And there are some tax treatment that differentiates them in the background, but in principle, they are very, very pretty much the same. And they are referred to as qualified retirement plan. And what that means is they are eligible for special tax benefits under the IRS guidelines. Really, essentially, what that means is that you don't get to pay tax on it while you put the money in it. Normally you pay your tax every year, but you can take money out of your income, put it into this qualified retirement plan without paying tax. And that means that money that you should have paid in tax gets to compound for you over time. If you had paid it to the government, it's not able to work for you. The power of compounding, you lose it over that amount. So if you put it into a qualified plan, it compounds without taxes. That's the power of these kind of investments, the 401k, 403b. Now, however, they are subject to early withdrawal penalties. Some people get tempted when you look at your 401k and it has a big amount in it, and maybe you're going through a challenge. You may get tempted to withdraw it. If you do, there's what they call any early withdrawal penalty. So when you file your taxes for the year, you pay. Let's say you took 10,000. You're going to pay additional 1,000 as taxes. Let's assume that the tax that you owe on that 10,000 is 2,000. So you should have paid 2,000 if you are taking it in future. But because you took it earlier than the retirement age of 59 and a half, or not, that's not retirement, but it's the age that you can take your 401, 403 without penalty, then you pay 10% more. So instead of paying 2,000, you pay 3,000. So you lose 1,000 simply because you took it before 59 and a half. Now you can take a loan for yourself, from your phone. You can take that same 10,000 as a loan, but you have to return it back if you take it as a loan. If you don't return it, then it is treated as a withdrawal and you get taxed 10% more. So the 457, which is the government one, government likes to take good care of themselves, is the non-qualified retirement plan. Essentially means it's not treated the same way. It's not subject to the same withdrawal rules as a 401k. So depending on when you take it, you may not have to pay the 10% as it were. So I already explained these blue bullets that you put pre-tax money into it. So I'll actually show you an example. I think I have it on the next slide or the next slide. Somebody asked me, okay, so does it make a difference? And it does make a difference whether you invest pre-tax or post-tax. Let me skip the next few bullets and actually see if I can explain that. Now, there are a couple of, actually, before I leave this slide, all right, so if there are annual limits to it, right? Because the government wants to hand their tax, so they don't want you putting all your money. Let's say somebody already has money to spend for the year. They will have said, I'll put all my money for the year in 401k so I don't have to pay tax. So the government, to avoid that or prevent that, they make sure that they put a limit to it so that they still charge you tax for the year, right? Now, there are some of these retirement plans that are matched by the employer to some level, and some are matched at 100% of whatever you are contributing or a less amount. Some are not even matched at all. So what a match means is your employer could say, look, if you are willing to put 5% aside from what we pay you for yourself, So let's say you earn $5,000 a month. 5% of that is $250. If you are willing to put $500 as $250 aside, we'll add $250 to it, and we'll put it into your retirement account. And we're not going to ask you for it, even if you leave us after you've stayed with us for X number of years. So essentially, you save 10% by saving 5%. Not only save it, you invest it. So I tell people that the minimum I want you to put into a 401k, 403b, 457 is whatever your employer is matching. So if the employer is matching at 3%, make sure you do not less than 3%. You can do more, but they are saying we will not do more than that, but you should do at least whatever your employer is willing to do. And I explained this when I was answering one of the questions earlier on. The money will be invested for your retirement, usually in your choice of mutual or index fund or the company stock, if it is publicly quoted. So you have to decide where they put the money in for you. It's very, very important. If you've not done that, I don't know if there's anyone on the line that have not looked at their account. Please don't assume it's in the right place. In the first place, I've explained to you tonight that you don't leave it in the company stock. I'm not saying sell all your company stock and put it into index fund, but my recommendation is you don't leave more than a third of your investment in the company stock. Preferably, actually make it like 20%. Let the 80-20 rule apply to it. So put 80% in index funds that represent the entire market, so that even if the company fails, there was an example of a company called Enron. I don't know if some of you on the line remember the story of the company called Enron. It's actually based here in Houston. And they made their employees, I don't think they enforced it, but most of their employees put their company into that company's, put their 401k into that company's stock because it was doing so well. Come to find out later down the line that they were kind of cutting costs here, cutting corners rather here and there. And when things happened, that the government IRS caught up to them, the company stock fell, like a hammer immediately, and people lost their life savings that they had kept into it. And even whatever seems to have grown because of the way the company stock was doing fell down to almost zero. So it's a risk, even if you work in a company that seems to be doing well. I tell people, don't leave all your money in your company stock. I can't say this enough. They've already helped you. They've added 5%, 4%, whatever it is to it. Take it, thank them for it. Leave only 20% in the company stock. Put the remaining 80% into an index fund. So if something happens to the company, you don't go down with the company. And somebody might say, what if the company does well? You don't take that kind of risk in investing. It's just not the way to manage. Remember asset allocation and diversification. Okay, I already mentioned the fact that you can't withdraw your money until you're 59 and a half, unless without a penalty. Okay, now there are contribution limits, which is really the same for all the three. There is, if you are under 50, regardless of what you earn, you are not allowed to put more than 23,000. These are the numbers from this year. So I updated it from, if you've seen the slides from previously, these are the ones for this year. If you're above 50, before you're 60, you can add an additional 7.5 every year. And then if you're between the age of 60 and 63, you can even add another, you can add 11.2. Okay, so if you're between 60 and 63, you can add 11.2 to 23.5. That means you can put 34,000 plus total potential. Now, if you're 50 plus, you can do 23.5 plus 7.5. That's 31, I think, for the year. That's what you can contribute into those plans. And then, please again, feel free to raise your hand and stop me if you have a question. There's what is called an IRA. There are various types of individual. So this one that we talked about, the 401k, employer-sponsored retirement plan. But you can also have your own retirement plan, which is what the IRA is, individual retirement account. And you can open this in your brokerage account, like I told you earlier on. You open an IRA in a brokerage account. Again, similar to 401k, is a tax deferred, account. That is, the money that you make in an IRA can compound without you owing tax on an annual basis. So it compounds. There are three types of IRAs. One is traditional, which you just simply open by yourself. And generally speaking, the term pre-tax can also be called tax deductible, right? So the money can grow tax deferred. That is, you don't hold tax on the growth. There is the Roth IRA, which is it's a magic that was created because even the money that grows, you don't hold tax on. Roth is the name of the Congress person that introduced it, and it got passed many years ago. It grows tax-free as long as what you put into it is post-tax contribution. Of course, you need to leave it in there for at least 5 years before you can take it for retirement, but it grows tax-free, and even the contributions and the growth is not taxed. That is powerful. That's whatever it grows. If your money grows to $1 million, you don't owe tax on it. That's powerful. And then there's the rollover IRA. Now, I will talk about the limits to Roth in a minute. Rollover IRA is if you own a 401k and you leave a company. When you leave a company, you can either leave your money in the company's 401k or 403b, or you can transfer it tax-free without incurring taxes into a rollover. That's what the word rollover really means. You roll it into an IRA, into a rollover IRA, and it continues to be treated. So when you leave the company and you roll it over, they're not going to transfer all the stocks that you have into your rollover IRA. No, but they'll liquidate it. Let's say it's worth $100,000. They'll liquidate it and move the money into your rollover IRA, and then you will now need to invest it into index fund in your rollover IRA. Okay, from either any of those three types of company-sponsored retirement account. So those are the three basic class of IRA. I want to quickly talk through the limits of a Roth. Remember, I told you that this money is not taxed. You don't hold taxes on it in the future, even though it grows. The maximum allowance as amount to set aside for it is $7,000. Now, if you're above 50, they allow you to put another $1,000. That's $8,000. However, there's a catch. If you are a single person, your modified adjusted gross income, your MAGI, they call it, MAGI, must be less than $150,000 for you to be allowed to put the money aside. If you earn more than that, you are generally not allowed. Now, if you're married and filing jointly, that amount grows to $236,000. So if you're married, you're not allowed to participate in a Roth IRA if you make $237,000, period. So they want it to be for those that are earning less. If you're single, they don't allow you to contribute if you're making $151,000. Okay, so that's the general rule. However, there's what they call the backdoor IRA. This is one thing that I kind of, in the past, if you've been in the class in the past, I didn't focus on this, but it's something to kind of think about. The Roth IRA. Now, remember that what you put into a traditional IRA, generally speaking, is post-tax money. So you've already paid tax and then you put it in there. Whatever it grows to be, the delta between what you put in, because that was already taxed, and what is grown, you owe tax on. With Roth IRA, you don't hold tax on because you put post-tax money in it as well, but you don't hold tax on. So, and then the rollover is what you roll from your other account, right? Now, the backdoor IRA is a tool that was created by the rich. So if you're saying we can't contribute money, because my wife and I are making $236, there is a back door, which is really not an IRA. That's why it's called a back Roth, backdoor Roth. It's not an official retirement account. What you do, this is the 3 steps to it. You open a traditional IRA and then you make after-tax contribution into it. For the year, of course, you're still limited. It's still subjected to the same, limit for if you're going to convert it to a backdoor Roth. And then at the end of the year, you file Form 8606, IRS Form 8606, and then you roll over that IRA into a Roth IRA through that filing of 8606, and it's called a Roth conversion. And then it begins to receive the treatment of a Roth IRA because you've Roth converted that traditional IRA into a Roth IRA. And there is no income limit. See, this second bullet is the key. It's not an official requirement account. It's an IRS approved tax strategy to get around the income limit. Okay, I think this might have an interest to those of you on the line that are making more than 150,000 if you're single and 236,000 if you're a couple. I would recommend that you take advantage of the backdoor Roth if you are making above that. If not, you lose the opportunity of participating in Roth IRA and all the tax benefits of not owing tax. I hope that makes sense. All right. So this just kind of summarizes the limit of 401k plus IRA contributions. Remember, if you're under 50, it's like 23.5, as I explained. You can put 7k in an IRA, limiting you to 35. If you are 50 plus, then you have the catch-ups that can be added to that can take you to like 39k if you are 50 plus. And then if you're 60 to 63, it has the other numbers that I said. Okay, again, this shows you the combined limits. I'm just trying to show you from different perspectives. The key point with what's it called? The backdoor is that it has no income limit, and that's very, very powerful. Okay. All right. Okay, I wanted to explain this. I've had questions in the past, and I think I've actually showed this in one of the classes previously. What difference does it make if you invest pre-tax or post-tax? And I'm not going to spend too much time on this. I want you to understand the key principle that I'm trying to explain. And it's very simplistic, but it makes the point. Let's say there are two individuals, Mr. A and Mr. B. Mr. A chooses to pay his tax today. So he puts all his money in invested money as post-tax payment because he doesn't want to owe a tax in the future. Whereas Mr. B puts money pre-tax into his own investment pre-tax. He still owes tax in the future on that money because he has not paid tax today. So that's the difference between Mr. A and Mr. B. Mr. A pays today. Mr. B in this example defers for 35 years. Let's say starting at age 25, and he doesn't want to pay his tax until 60 in retirement. So Mr. A, they both earn 5,000. So this guy does not put money in 401k. So his taxable money is still 5,000. Let's say his tax bracket is 20%, so he pays 1,000 in taxes. His expenses and Mr. B's expenses are the same. So they both owe, spend the same money monthly. He has $500 left. So 5,000 minus 1,000 tax minus expenses, that's the balance of 500 to invest. And then, he invests $240, and then he saves $260. I'm fixing some amount so that you can see the difference. The amount that they both kept as savings is $260. But since he has $3,500 expense, 1,000 taxes, and the balance of 500, only money he has to invest will have to be $240. And he's investing it after tax so that he doesn't pay future taxes, right? If you sum up the taxes that he paid at 20%, The incremental taxes that he pays is 25,200. And I'll show you what I mean by that, because it's incremental over these other guys. So the other guy makes his own 401k investment before tax. So he puts 6% into 401k, which is 300. And then his taxable income reduces to 4,700 because that is reduced before his taxable income. And he also pays 20% as tax, right? So is 20% of this is 940. Remember, the expense has to be the same to be able to do the comparison. Okay, so he has the benefit of extra 60 because remember, this other guy has gone down to 240 that he could invest. He can invest 300 versus 240, so extra 60 is able to invest. The savings has to be the same. If you use the compound interest spreadsheet, you can calculate the difference. The nominal value of that $60 a month over 35 years is $195,000. And you know, the tax that they pay, let's say is now has to pay what's it called? 30% taxes, so a higher tax in the future. It's still 30% of 195 is 58. So the difference between that and the guy that paid 25,200, the difference between those two numbers is the 33,000. If I subtract his incremental because he paid more over time in the future, the difference is between this and that is 161. So the point is, he still makes more money in the long run than the other guy. You know, I need to maybe look at one or two of the numbers. But the point is, now these are nominal numbers. These are not real numbers because there's inflation and all of that, and it's quite simplistic. However, the point I'm making is that in as much as you can, as much as you can, invest pre-tax because the difference can compound for you, and over time, even though you owe taxes, has better financial value for you. Now, if you bring all those money to today's value, that is, you do what they call discounting, you can really calculate the impact of 161 today, all these taxes to today. For it to be accurately calculated, depends on a number of things, but simplistically speaking, it makes sense to pay those taxes in the future than to pay it today, is the point I'm trying to make. I hope that makes sense. All right, I think I'm almost at the end of the class. I explained to us that asset allocation is really the key, and diversification. Really, asset allocation and diversification is the key once you start investing. Remember, what you're now trying to do is, where do I now put all this money that I'm able to save in order to get this 10%, 8%, whatever goal that I want? You need to put it in different investment classes, which is what asset allocation is all about. Investing in stocks and in index funds or mutual fund is still the same asset class. It's company stock, even though it's going through a stock or direct stock ownership, is still the same. So you need to look for other things when it comes to allocation. There are various things to look for. There are bonds. I don't think I'll have the privilege of talking in detail about bonds today, but I'll see what I can do. Real estate, annuities, and of course you want to keep some money like in the money market and CDs. So those are the various places to kind of park your money. And then if you look at, let's say you have to allocate 30% to stocks and indexes, right? You're going to then put that into different types of companies. That's what is called diversification. You put it into US companies, you put it into international companies, but it's still the same. You're allocating 30% into a particular asset class. That's allocation. But even within that asset class, you diversify. You put it in different companies across different countries and different types of companies, from technology to retail, from retail to banking or finance, across the board. That is diversification within an asset class. Those are the key or the tool that will help you when it comes to growing your money over time and reducing your risk. You're not depending on the performance of a particular sector of the industry. That's the difference between allocation and diversification. There's quite a bit of words that I have in here, but that is really the difference. And then you're putting it into large companies, to small companies, to middle company. That's what is called market capitalization. I don't know if I explained market capitalization the last time. Is really what it will cost me to buy a company. That's its market capitalization. If I have enough money, I can potentially buy the whole company of Apple today. But what will it cost me? I will have to multiply every stock that they have in the market by the total number of stock they own, which runs into a couple of trillions of dollars today. If I have that money, I can buy that company. It's called the market capitalization. A large company or a company with a large market cap has over 10 billion in their market cap. It's called a large cap. A medium market capitalization company is between 2 and 10 billion. Small is 300 million to 2 billion. And the micro cap is between 50 and 300 million. Okay. Now, someone has asked me before, so what percent should go into which bucket between stocks and bonds, real estate, annuities? What should go into what? A number of things needs to be taken into consideration. Is where you are at, your stage in life. Someone that is older is probably less risk prone. It can't take as much risk than someone that is in their 20s or early 30s. The older you get to, the more you need to reduce the riskiness of your stocks. And of course, how much risk you're willing to take is another thing that's important, as well as how much money you have at hand that is liquid. Those are things that generally impact that should impact. There's a very important individual. His name is Ray Dalio. I've recommended one of his books to us to read. He's one of the most successful people when it comes to investing. And this is what he calls his all-weather funds. If you put 30%, this is what he recommends: 30% stocks and indexes, and then 40% in long-term bonds, 15% in intermediate term, but 7-8% in gold, 7-8% in commodities. That's what he recommends. And what the point is that it manages your risk and allows you to wade through various volatility across time. I think I shared a video on the chat. Please watch that and think through some of what I've said, what it says there. It's on how market behaves or something like that. Now, one thing I've always also tried to explain, I don't know if I've explained this in this class before, is that stocks are usually more volatile. So if you put more than 30% in stocks, your overall portfolio is actually not 30% risky. It's probably about double that in terms of the risk that you're bearing. Okay, so that's why he recommends not to go beyond 30%. I think that makes sense, to put into stocks and index funds, and then the others should go into the different types of investment vehicles. Okay, this is the same link that I was talking about. I would like you to go back and look at it if you haven't, how the economic machine works. Please listen to that. Go back into our chat. If you were not there when I posted it, I can actually repost it again and you can have a look at it. This is, what I recommend that people do. Depends on where you're at. About 20-30% in stock, US stocks, 10% in international stocks, again, using funds, index funds to actually accomplish those. So between 30 and 40% in stocks, US and international, 30 to 40% in long-term and intermediate treasury bonds. And that will match something similar to what Ray Dalio said in his long-term bonds, but I want to spread it in both long and intermediate. And then, 20% in real estate or real estate trust, REITs, as well as 10% in CDs. And I explain, why I recommend this: to perform well during the period of rising growth or economic expansion, which is why I want you to listen to this video. Stocks will help you. If the economy is contracting or deflating, bonds will help you. If you go into real estate, it gives you growth and safety. And then to edge against, inflation, CDs kind of helps you. So get a CD that is above inflation rate. It will help you over time. Okay, so that's kind of what I generally will recommend, or something in that frame. Now, this is where we'll end tonight. The assignment is I will send a sheet of the Vanguard 500 index index fund, institutional index fund to you. And these are the questions. For those that have been in the class in the past, you've already done this, and you can do it again just to refresh your memory. If you're new to the class, I'll post the sheet. Do this assignment. Find the NAV, the market capitalization category, the net assets, 12-month low to high NAV range for that stock, the expense ratio, both the gross and the net, the turnover rate. Remember, I defined all of those earlier. The 3-year annualized rate of return on this fund, what the index tracks, what index the fund tracks. How does the fund's lifetime performance compare with S&P 500? Which company makes up the fund's top 10 holdings, and what is the percentage of the fund's portfolio? How does the fund compare with the Vanguard Prime Cap Mutual Fund, which I will post? So 3 things I'll post. I'll post the Excel that we saw earlier on for budgeting. I'll post this question, and then I'll post the 2 prospectives for this Vanguard Index Fund and the Mutual Fund. 4 things. Okay, that's where we end tonight. If you have any question, we're kind of out of time, but please feel free to ask as we wrap up tonight. Any question? All right. Looks like we all got it. I know it's a lot, but please do this assignment and to make it kind of clearer to you. Let me know if you have any question outside of the class. I know I went through a lot of material in a very short time. So please feel free to reach out if you have a question at any point in time in the course of the week or something like that. Okay, let's have a nice weekend, remainder of our weekend, and see you next time. We have one more class and we'll close after that. Thanks, everyone.
Thank you.
Yeah.
Thank you, sir.
Absolutely.
Thank you, sir.
Thanks,
Thank you.
everyone. Yeah.
Thank you, Daddy.
God bless you.
Thank you.
Bye-bye. Thank you,
Yes,
Pastor.
Yes, sir.
Sir.
Thank you.
Yes, sir. Good.
Yeah, good night. Bukola, good night.